Hi everybody, my name is Griffin Bridgers. This is part 4 of the basics of GST tax, or Generation Skipping Transfer Tax, long form. Today we're going to dive into the definition of the GST tax exemption. Now before we get started, I want to remind you again that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, the disclaimer is that this series is designed to teach the basics of Generation Skipping Transfer Tax, or GST tax, as I refer to it through this series, shorthand, to anybody who deals with intergenerational transfers of wealth, be it attorneys, trust officers, wealth advisors, CPAs, and any other aligned professionals. But this series does assume that you know some basics of the estate tax and the gift tax, the calculation thereof, and associated deductions and credits and exclusions. So, to get maximum value, I suggest you be familiar with gift and estate taxes first, although that's not necessarily fatal to your understanding of this course, but it will become a bigger issue as we go further and further along. So far, we've learned that the GST tax is heavily dependent on a multitude of definitions. There's a lot of them throughout the code which apply to the GST tax. Some of the ones we've learned about so far are the generation skipping transfer, which is the ticket to entry to have a GST tax liability. And to have a generation skipping transfer, you have to have two specific parties, a transferor and a skip person, who are defined based on difference in age or generation assignment between the two of them. And you also potentially have direct transfers to a skip person called direct skips, which are going to be given, as we'll see later, their own set of rules, which are a little bit different, and their own reporting procedures, which are a bit different than those that apply to other forms of generation skipping transfers, namely the taxable termination or the taxable distribution. So before we cover those other two categories of generation skipping transfer, we have to take a step back. We have to understand the dynamic of the GST tax exemption. Why? Because it's the allocation of this exemption which will control the GST tax liability at the time that there is any form of generation skipping transfer of any type, especially one that might happen in the future. Because as we learned in the last class, there's a timing difference between the direct skip, at which point there's a GST tax immediately, potentially, versus a taxable termination or a taxable distribution, which defers the GST tax liability to some point in the future. And the determination of that GST tax liability at that point in the future will be heavily dependent on an upfront allocation of the GST tax exemption, which we'll dive into in great detail across a number of courses. But to refresh our memory, I want to give you the visual again of what the GST tax is aiming to help the IRS avoid, which is missing out on a layer of estate tax. So this is following a hypothetical where there's $100,000 in wealth being transferred between generations, and if it were to pass to generation 2, there'd be an estate tax of $35 million and change. When generation 2 leaves it to generation 3, there's a potential estate tax of $21 million and change, which depletes the estate down to $43 million and change across two generations. So the GST tax is designed to avoid an issue where you could, as generation 1, make a transfer directly to generation 3 to remove some or all of this potential second layer of estate tax of $21 million, which could come into play. So that being said, the GST tax exemption is defined in Code Section 2631, which notes that every individual is given a GST exemption amount. Now, the language of the statute is important because it's important to know the why behind the GST tax exemption and what it affects downstream. So the language of the statute is pretty clear that the GST exemption is, quote, for purposes of determining the inclusion ratio. Now that's an important point to remember, and I'll paraphrase it a bit down below, but we're not going to get into the inclusion ratio yet, because even though it's covered later, it's going to determine our applicable GST tax rate. And what we're going to find out is that this amount could be anywhere between 0% and the maximum federal estate tax rate at whatever amount it might be at the time. Currently, that max is 40%. It could go up in the future, could go down, we just don't know. But we can reach this conclusion is that the GST exemption that's allocated to a transfer directly determines the rate of GST tax, which will apply now or potentially in the future. So what we're going to find out is, see where I noted that you can have a rate between 0% and the maximum federal estate tax rate? That's based on the inclusion ratio, and really you lock in that inclusion ratio at the time of a transfer and thus lock in the rate of GST tax, which will apply now and in the future as well, as long as there's no change to the transferor. So, how do we really get into this? How does the GST tax exemption affect the rate? Before we get into the inclusion ratio and the applicable rate and everything else that's associated with those terms, there's another clue found in Code Section 2631, which says, paraphrased, every individual has a GST exemption amount which may be allocated to any property with respect to which such individual is the transferor. So, as we covered last time, if you're the transferor, you're making a transfer to or for the benefit of a skip person, you have the choice to allocate GST exemption amount to that transfer, which will determine the inclusion ratio and the applicable rate for that transfer now and in the future. So, really the mechanics we're going to learn over time is that this GST exemption amount is allocated to property that is transferred by an individual who has the status of transferor with respect to a generation skipping transfer. So I know that's a mouthful, but really allocation is italicized here because it's going to drive this. And property is italicized because it's going to be the value of that property that determines the amount of GST tax exemption that is indeed allocated. Now, this isn't a presentation today about the allocation itself. That's to come, because before we can get into allocation, we have to know what our GST exemption amount is. And that's defined in Code Section 2631C, which defines the GST exemption amount as an amount equal to the basic exclusion amount under Code Section 2010C. Now, this is where it helps to be familiar with the estate tax, because basic exclusion amount is an estate tax term and a gift tax term. It's the dollar amount under statute that's used to determine the estate and gift tax applicable credit amount of every individual. So currently, that amount is $12,060,000 for 2022. That's based on 10 million indexed for inflation every year through 2026, but on January 1 of 2026, this inflation adjusted amount will be reduced by 1/2 due to the sunset of the Tax Cuts and Jobs Act of 2017. Now, what this does not include in either the definition of the basic exclusion amount or the definition of the GST exemption amount is any portion of a deceased spouse's unused exclusion amount, because Code Section 2010C defines the applicable exclusion amount as being the sum of the basic exclusion amount plus any deceased spousal unused exclusion. So the big picture here, the big takeaway is that a deceased spouse cannot preserve their unused GST tax exemption. So an individual's GST exemption amount is always going to be $12,060,000 or whatever amount is determined under statute, reduced by any prior allocations you might have made of that GST exemption amount. So now that you know the exemption amount, that tees you up in our next series of presentations to dive further down the rabbit hole of many definitions which apply for purposes of allocating GST exemption. And it's important to know the allocation and the mechanics, because that's going to drive our determination of the other categories of generation skipping transfer, being a taxable termination or a taxable distribution. So what's coming is a deeper dive into Code Section 2632, which contains many rules and definitions in the code and in the regs associated with that code section governing the allocation of an individual's GST exemption, really to two types of transfers. One, a direct skip, which we've already learned about, and two, an indirect skip, which is to a GST trust, which we will soon learn about, and subject to one thing I don't mention on this slide, which is an estate tax inclusion period, or ETIP. All of that's to come, but as you can see with these many definitions coming at you like a fire hose, there's a lot to cover and a lot of terms. So what's helpful so far is to cover a glossary of terms for review because, as I mentioned, GST tax and this course itself is heavily definition driven and definition dependent. So for review, it's important to go back and familiarize yourself, if you haven't already, with these terms: a generation skipping transfer, a transferor and skip person who are the parties to a generation skipping transfer, a direct skip, which is a direct transfer from a transferor to a skip person, and the GST exemption amount, which is the basic exclusion amount defined under Code Section 2010C, which we discussed today, but not including any deceased spouse's unused exclusion amount. Thank you again for joining me for this part 4 of the basics of GST tax. If you have any questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for joining me for this video, and I look forward to seeing you in my future content.